Most people believe that national success comes from hard work, smart leadership, or natural resources. But what if the real story is far more complicated? What if prosperity and failure are not simply the result of internal decisions, but the outcome of forces that operate quietly in the background, forces that most citizens never see, leaders rarely admit, and history only reveals in hindsight? Today, we uncover the hidden mechanisms that decide which countries rise and which slowly crumble. To understand these forces, we must travel back to the earliest foundations of global economies. Long before modern economics existed, in the era of empires, wealth seemed simple: land, food, gold, armies. But beneath the surface, real power was shifting. Banking networks, merchant guilds, and early financial institutions were beginning to shape the fates of nations more than kings ever could. Yet few recognized the significance of this transformation. As European trade expanded across oceans, a new pattern emerged. Nations that controlled trade routes thrived, while those that relied on raw resources lagged behind. But trade was only the visible layer. The invisible layer, credit, loans, and interest, became the real engine of national expansion. Countries that could borrow cheaply grew rapidly. Those that couldn't remained stagnant. The hidden force of capital access was beginning to decide the winners. The rise of central banks in the 17th and 18th centuries accelerated this divide. These institutions had the power to stabilize economies or destabilize them, often without the public ever knowing. Nations with strong central banks gained financial resilience, while others fell into cycles of inflation, default, and crisis. Prosperity was no longer only about territory or armies. It was about who controlled the flow of money. Industrialization magnified these disparities. Nations that embraced industry early surged ahead, creating factories, railways, and urban centers that produced unprecedented wealth. But growth came with a price: speculation, bubbles, and sudden collapses. Investors, not governments, began directing economic expansion. The hidden drivers were shifting again, and nations unable to attract foreign investment struggled to catch up. By the late 19th century, powerful banking families and global financiers influenced national policies, wars, and political movements. Their decisions, often made in private rooms and quiet meetings, determined credit availability, industrial development, and even government survival. While nations celebrated their industrial triumphs, the public remained unaware of how dependent their prosperity was on financial actors they would never meet. The early 20th century revealed how fragile this system truly was. Speculation drove economies into dangerous territory. When the boom ended in 1929, the Great Depression exposed how interconnected and vulnerable nations had become. Factories shut down, millions lost jobs, and global trade collapsed. But the real lesson was hidden. Countries with diversified industries and strong financial institutions recovered faster, while fragile economies plunged deeper into crisis. Policymakers responded by building new institutions like the IMF, World Bank, and the modern Federal Reserve System, believing that global coordination could prevent another catastrophe. But these institutions created a new hierarchy. Nations that aligned with global financial rules gained access to loans, support, and investment. Those that didn't were left isolated. International approval became a hidden force, determining prosperity. After World War II, the Bretton Woods system reshaped the global economy. The US dollar became the world's anchor, giving the United States unprecedented influence over global trade and finance. Countries that integrated into this system enjoyed stability and growth, while others struggled with inflation, shortages, and political turmoil. The structure of global finance had become a determining factor in a nation's fate. When the Bretton Woods system collapsed in 1971, the world entered a new era of floating currencies and volatile markets. Oil shocks, inflation spikes, and currency crises hit nations unevenly. Countries with strong institutions adapted. Others spiraled into chaos. The invisible force of market confidence became a major factor in determining prosperity. In the 1980s, developing countries borrowed heavily to industrialize, encouraged by global lenders promising rapid growth. But rising interest rates in the United States triggered a debt crisis that crushed nations across Latin America and Africa. When they defaulted, international institutions imposed strict conditions: privatization. Some nations recovered, many did not. The rules of prosperity were no longer set domestically, but globally. The end of the Cold War reshaped economic alliances. Nations that embraced globalization rose rapidly, joining supply chains and attracting investment. But those that resisted or lacked institutional capacity fell behind. Wealth now flowed to countries that could produce cheaply, trade efficiently, and maintain political stability. The invisible force of global competitiveness determined winners in this new landscape. Then came the Asian financial miracle and the Asian financial crisis. Rapid growth in the 1990s attracted massive foreign investment, but speculative bubbles built quietly. When confidence faltered in 1997, currencies collapsed almost overnight. International rescue packages saved some economies while permanently altering others. The lesson was clear. Nations did not rise or fall solely by their own actions, but by how global markets perceived them. The early 2000s brought another shift. Technologies expanded global trade, data transformed finance, and capital moved faster than governments could react. Nations with strong digital infrastructure surged ahead, while those without it struggled to participate. The invisible force of technological adoption became a decisive factor in economic success. 10K May 2, 2008. Global financial crisis. It began in the U.S. housing market but spread worldwide within weeks, proving once again that no country is isolated from the global financial system. Nations with strong banking regulations survived. Those with fragile systems collapsed. Prosperity was increasingly tied to financial resilience rather than natural resources or population size. After 2008, the world entered an era of low interest rates, cheap borrowing, and massive debt accumulation. Nations used debt to build infrastructure, fund social programs, and stimulate growth. But this created new vulnerabilities. Countries with high debt became dependent on global lenders and international markets, limiting their ability to control their own destiny. Debt became a silent force shaping long-term prosperity. Today, the hidden forces influencing national success are more complex than ever. Global supply chains link nations economically, politically, and technologically. A disruption in one region can cause shortages, inflation, or unemployment in another. Countries with flexible economies and diversified industries thrive. Those dependent on a single sector struggle. Global institutions continue to shape outcomes. Credit ratings determine how cheaply nations can borrow. Trade organizations decide which countries gain access to markets. Central banks influence global capital flows with a single policy decision. These institutions may not appear in election campaigns or political debates, but they quietly influence whether a nation prospers or fails. Another hidden force is geopolitical alignment. Nations aligned with powerful economic blocs like the United States, the European Union, or China receive investment, trade opportunities, and technological partnerships. Those caught between rival powers often face instability, sanctions, or forced dependency. The global balance of power continues to determine national outcomes. Technological inequality is also reshaping prosperity. Countries investing heavily in artificial intelligence, automation, and digital infrastructure are building the economies of the future. Others are struggling to transition from traditional industries. The divide is growing, creating a world where prosperity increasingly depends on digital capability. Climate change adds another layer of complexity. Nations vulnerable to extreme weather faced economic losses, food instability, and energy challenges. Wealthier nations can adapt. Poorer nations cannot. Environmental vulnerability has become a hidden determinant of long-term success. As global threats evolve, so do the forces shaping national prosperity. Cybersecurity, energy independence, data control, and technological sovereignty are becoming critical factors. Countries that excel in these areas will rise. Those that fall behind may face rapid decline. Through all these phases, historical, industrial, financial, technological, one truth becomes clear. Nations do not prosper or fail solely because of internal decisions. Their fate is shaped by global systems, institutional structures, financial networks, and geopolitical realities that operate quietly in the background. From this journey, three major takeaways emerge. First, prosperity depends not just on national policy, but on integration into global systems. Second, economic strength requires institutional resilience, not just natural resources or population size. Third, the forces shaping national success are shifting faster than ever, making adaptability more important than tradition. As we look toward the future, the question is not which nations are powerful today, but which are preparing for the hidden forces that will define tomorrow. Technology, climate, geopolitics, and global finance are evolving rapidly. The next era of prosperity will belong to nations that understand these forces before others even notice them. If you found this deep dive valuable, stay curious, stay aware, and consider subscribing for more investigations into the unseen systems shaping our world. The forces deciding the future of nations are already in motion, and understanding them starts right here.